Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate speak, and today we are diving into Chase General Corporation's latest financial checkup. Get ready because this report is a real mixed bag showing us a company fighting hard to stay afloat. This is Chase General Corporation's quarterly report filed with the Securities and Exchange Commission, or CC gives us a look at how the company has been doing financially for the 3 months ending the 30th of September 2025. Think of it as a quick health checkup for the business. First off, let's get a sense of the company's structure. Chase General Corporation is based in Missouri and it has a subsidiary called Dye Candy Company. This subsidiary is where the actual candy making and selling happens. They operate two main parts of the business, Chase Candy and Seasonal Candy, but management actually considers them one single part of the business when they report things. Now, let us jump into the numbers. Looking at their balance sheet, which is like a snapshot of what the company owns and owes, we see some interesting movements on the 30th of September 2025. Their total assets jumped significantly to over $1.9 billion, up from about $1.48 billion on the 30th of June 2025. This big increase in assets is mainly due to a massive jump in trade receivables, up to over $613 million. This means customers owe them a lot more money now. On the flip side, their cash and cash equivalents saw a healthy increase from around 47 million to over 61 million. But it is not all good news on the balance sheet. Their liabilities also went up quite a bit, from about 785 million to over $1.24 billion. A big chunk of this increase is in accounts payable, which shot up from just over 91 million to almost $287 million. This means Chase owes its suppliers a lot more money now. Now let's talk about what is inside the company, the stockholders' equity. The company shows a really significant accumulated deficit on the 30th of June 2025. This deficit was close to $5.77 billion, and by the 30th of September 2025, it had grown to over $5.8 billion. This means the company has lost a lot of money over its lifetime. Moving on to the income statement, this shows how the company performed in terms of making money. For the 3 months ending the 30th of September 2025, Chase reported sales of over $791 million. That is a pretty good chunk of change, but it is actually a drop of about 20% compared to the same period last year when sales were nearly $989 million. Looking at the different parts of the business, their Chase Candy division actually saw a nice sales increase of 12%, bringing in over $356 million. That is a bright spot. However, their Seasonal Candy division took a massive hit, with sales dropping by 35% down to $434 million. This is a big deal. Losing that much sales is like losing one out of every 3 customers in that part of the business. Even though sales dropped overall, the good news is that their cost of sales also decreased by about 25%. This means they spent less money to make the products they sold. This decrease in cost of sales is related to things like labor efficiencies that management put in place. But not all expenses went down. General and administrative expenses actually went up by about $14,000 to over $218,000. This part of the business is taking up a bigger piece of their sales pie, going from 21% of sales to 28%. This is not ideal, especially when sales are falling. And when you put all of this together, the company reported a net loss of over $40,000 for the 3 months ending the 30th of September 2025. This is worse than the nearly $18,000 loss they had in the same period last year. When you factor in those preferred dividends, the net loss for common stockholders really adds up, reaching over $72,000 for the quarter. This is a significant increase in losses for their actual owners. Now let's look at cash flow. This report clearly shows that the company is using more cash than it is generating from its day-to-day operations. For the 3 months ending the 30th of September 2025, they used over $234,000 in operating activities. This is better than last year when they used over $322,000. But it still shows they are not generating enough cash from selling their products to cover their costs. Where are they getting the cash then? Well, they are borrowing it. Their financing activities provided over $249,000. This means they are borrowing money to keep the lights on and fund their operations, which is not a sustainable long-term strategy. Despite using cash from operations, their overall cash balance actually increased by about $14,000 to over $61,000. This is because they received more cash from borrowing than they used for operations. In the notes to the financial statements, we find some really important context. The company is admitting that they have incurred significant operating losses since they started. They also mention losing 2 major customers, which they expect to cut sales by about 17%. This is a huge deal and clearly a major challenge they are facing. And here is where it gets really serious under the heading Going Concern and Management's Plan. They are essentially saying that there is a real question about whether the company can continue to operate. They have an accumulated deficit of almost $6 million and very little cash. Losing those major customers is a big problem, they acknowledge. Management's plan involves expanding their market, controlling costs, and trying to refinance their debt. They are also hoping to extend their line of credit. The earnings per share numbers tell a similar story. For every share of common stock out there, the company is losing money. The loss per share is about 7 cents for the quarter. When you add on the preferred dividends, the loss for common stockholders gets even bigger. There is also a related party transaction here. The company is leasing its office and manufacturing facility from an entity owned by the son of the chief executive officer. While this is not inherently bad, it is something to note when looking at the company's expenses. The monthly lease payments are $8,500. Now, let's look at what management is saying about all of this in their discussion and analysis. They are acknowledging the loss of 2 major customers and the impact this is having on sales. They mentioned implementing price increases on some products, which is helping with margins, especially in the seasonal candy division. But overall sales are down significantly. This table clearly shows the percentage breakdown of their sales and expenses. For the 3 months ending the 30th of September 2025, their sales were 100% of the picture. Cost of sales took up 67% gross profit, which is what is left after paying for the direct costs of producing goods, was 33%, but then operating expenses, like selling and administrative costs, took up 37% of sales. This means their operating expenses are actually higher than their gross profit, leading to an operating loss. This is a key problem. Their general and administrative expenses, which is money spent on running the business like salaries for executives and office staff, professional fees and insurance, have gone up for the 3 months ending the 30th of September 2025. These expenses were 28% of sales, up from 21% in the same period last year. This is a significant increase and a major concern. The bottom line is a net loss applicable to common stockholders. This is the money that is left over after all expenses and preferred dividends are paid, and in this case, it is a loss. They lost over $72,000 for the quarter, increasing their overall deficit. Regarding liquidity and capital resources, the company's cash position improved slightly due to financing activities, meaning they borrowed money. However, they are still using more cash in their operations than they are bringing in. This is a sign of financial strain. Management believes their plans will help them continue as a going concern, but they admit there is uncertainty. In the controls and procedures section, there is a frank admission of a material weakness in their internal financial reporting. They say they lack accounting personnel with the right knowledge and experience to properly assess their internal controls. This is a red flag for investors, as it suggests potential issues with how financial information is managed and reported. They also mention a failure to maintain proper segregation of duties over system access, which can increase the risk of fraud or error. For legal proceedings, the report states none. That is good news, at least for now, meaning no major lawsuits are weighing them down. As a smaller reporting company, they do not have to detail their risk factors. However, based on the financial statements and management's discussion, the risks are pretty clear: losing major customers, increasing expenses, and the general struggle to turn a profit. Under other information, they mention their clawback policy related to executive compensation. They state there were no accounting restatements that would trigger a recovery of incentive-based compensation. So, no money was clawed back from executives during this period. Finally, the exhibits section lists standard certifications from the CEO and treasurer, and information about their financial statements being in IXBRL format, which is a digital way to present financial data. So, what is the real story here? Chase General Corporation, through its subsidiary Die Candy Company, is facing serious challenges. While they are making an effort to cut costs and their Chase Candy division is showing some resilience, the significant drop in seasonal candy sales, the increase in operating expenses like general and administrative costs, and the growing accumulated deficit paint a concerning picture. They are relying on borrowing money to stay afloat, and management openly admits there is substantial doubt about their ability to continue as a going concern. The internal control weaknesses are also a worrying sign for investors. Ultimately, the company's future hinges on their ability to win back customers, manage their expenses effectively, and successfully refinance their debt. Without a significant turnaround, the path ahead looks very difficult. Alright, that is our deep dive into Chase General Corporation's latest filing. What do you think about their financial situation and their go-forward strategy? Let us know in the comments below. If you found this breakdown helpful, giving this video a like is a huge help, and subscribe for more of these corporate deep dives. And don't forget to join our Discord community linked in the description. Thanks for watching, and we will see you next time.